And welcome back once again, options traders. And another topic that I think is critically important for new traders is to understand the opportunity cost of rolling, and in particular for short-term trades. Now, I'm a big fan of rolling. You've heard me talk about it in many videos. It's an important concept and hedging strategy for traders. But like all strategies, there are pros and cons. There are times when they work well and times when they don't work so well. And so this is something you have to be very careful of if you are rolling your short-term options, because there can be a very big opportunity cost. So let's go find out what that is. And before we do, as always, please be sure to click like and subscribe. Definitely appreciate it and helps so much to promote the channel. So there's a lot of different types of rolls, but what I'm speaking mostly about in this video is about a roll up, at least for calls. We can do a similar thing by rolling down for puts, but for this video, I'm just going to focus on rolling up because the concept's exactly the same in the opposite direction for the puts. So let's say that you buy a $100 call and it costs you $6. And at a later time, you sell this call, but you collect 10. And so what you're doing is saying, okay, I can collect this $10, but now I'm going to put some of that back into a higher strike, maybe the 105. So I've collected 10, I've spent 6, or in the business, we would say that was executed for a net credit of $4. So here's what happened is that you spent 6, you just collected $4 back, so now you really have a net of $2 as your total exposure. That's the main reason for doing the roll-up, is to reduce that maximum potential loss. So here's what this roll-up looks like graphically. Here's our $100 call, there's our strike that we always talk about. There's the initial $6 cost. The stock moves up to a level that allows us to sell the 100 and buy the 105 for a net credit of 4. So we have now shifted from the red curve to the blue. So I used to have a maximum loss of 6, but because I've now collected 4, my max loss is 2. So once again, this is the main reason for doing the roll. I have sharply reduced the amount that I could lose. Now there's one trade-off that we've talked about before, and that is that the break-even point gets shifted forward a little bit as well. And in fact, it's going to be the difference of the amount of credit that you received versus the difference in strikes. So for example, I've rolled from the 100 to the 105. That's a $5 difference in strikes. I collected $4. I didn't collect 5, I collected 4. And so that remaining dollar shows up as an increase in the break-even point. And that's why the blue line is shifted over here to the right a little bit compared to the red, which was the original line. So this is one opportunity cost right here. But there's another one that I wanted to make the bigger point of in this video. But the idea is that traders just like to continue rolling. What they're really hoping for is at some point in the future, they might be able to roll, let's say, to the 110 strike for a net gain of 2. Guaranteed gain of 2. Notice how this is entirely above 0. So that's really what they're hoping for. But as I mentioned, if you're dealing with short-term options, there's probably not enough time to have this happen. Now, if you happen to get a really big, massive gap off the opening bell, sure. If you can put yourself into this position, that's fine. But what I see a lot of traders do is they start doing these rolls for $2 and $3, and they don't recognize the opportunity cost. So to see it in detail, let's go look at a pricing model, some option prices generated from a theoretical pricing model, and you can definitely see the opportunity cost. So to do that, let's go over to an Excel spreadsheet. Okay, so now we're into an Excel spreadsheet, and what I've done is I've just run some numbers here, some option prices through a pricing model. So we have some stock prices here in the first column. We have the $100 call with 30 days to expiration, and then with 25 days to expiration. Over here, we've got the 105 strike with 25 days and 20 days to expiration. And then over here, we've got the 110 call with 20 days to expiration. Right next to it, we have the original $100 call, also with 20 days to expiration. Yes, I know it looks confusing, but I just wanted to at least explain the columns. So here's a really good way to understand your opportunity cost. Let's say that with 30 days to expiration, the stock's at 100, you buy the $100 at the money call for 503. Now, to really exaggerate the point, we're going to make exaggerated movements. Let's say the stock rises to 105 after 5 days. So notice that call now has 25 days till expiration, and it's theoretically trading for 762. If you'd like to roll it to the 105 call, we look at this column. The 105 call has 25 days till expiration, assuming we're looking for the same expiration date, and it's trading for 482. So you could roll this for a credit of 280. That's because you're selling your 100 call for 762, you're buying the 105 for 482. That's a net credit of $2.80 in your pocket. Now let's assume the stock runs another 5 points to 110, and you want to roll from the 105 call to the 110. And that's over here. So 5 days later, your 105 call has 20 days until expiration. It's trading for 736, and the 110 call, also with 20 days to expiration, is trading for 452. So the roll, you're going to collect 736, spend 452, is a credit of 284. So notice that your credits are about equal. They're about $2.80. So in total, you've collected $5.64. But remember, you initially spent $5. So right now, you've got a guaranteed gain of 61 cents, and that's what this is over here. But take a look at what you're holding. You're holding the 110 call with 20 days until expiration. It's still an at-the-money option. So do you really think it's going to beat the opportunity cost? And what is that? Well, that's the decision if we had done nothing. See, if we had bought the call, the 100 call for 503, and we just held it, right here it's worth 1103. That's the original 100 call with 20 days to expiration. So if we sell it for this price, right here, roughly 1103, subtract out our purchase price, that is 601. So there is a very clear indication of your opportunity cost. What happened here is because you rolled the option, you gave up $6, or what would have been a $6 gain. But because you were so fearful of the downside, and because you rolled it, all you really did was to get your money back. And so yes, right now you've got 20 days to expiration, and you've got 61 cents in your pocket. You've got an at-the-money option that might climb another $5 or $6, in which case you would be equal. But we haven't seen that happen yet. This is a big question mark. But what we do know is that you gave up this. Now, of course, we didn't know that the stock was going to rise, and that's really what the big decision comes down to. But the point that I wanted to make here for all of the new traders is you have to realize that if you're taking very quick rolls and trying to scrape up $1, $1.50 or something like this, and it's a short-term option, in most cases you're going to be lucky just to get your money back, and yet you gave up some for sure profits. So just keep that in mind. If you've got an option, let's say you paid $5 for it, you can sell it for $7. That's a guaranteed 2 in the pocket at that moment. But if you roll it, you're going to get a fraction of that back. So you have to have a much better reason for rolling it other than saying, oh, I get a credit. So this is another problem that traders have. They just get too focused on the word credit, and they want to roll to get these credits, and they don't take a moment to think about what they are giving up, that opportunity cost, by rolling that option. So another thing you can do to check is to say, would I buy the 110 call with 20 days to expiration right now for 452? And if you're saying, I don't know if that looks like such a hot deal, then we probably shouldn't roll to it either. And so that's another way you can check yourself to see if it makes sense to give up the opportunity cost in exchange for perhaps making more over a short period of time. So before you roll, always make sure to account for the profits you could have for sure versus the profits you might have if you roll. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.